Stanbic Bank released the full year results for 2021, and they seem to be quite delicious or quite good. For me as a
dividend guy,
and Stanbic, I think, is perhaps the only bank outside Standard Chartered that issued an interim dividend in the half year results.
They did issue an interim dividend.
Yeah, I think all the other banks were, apart from Standard Chartered, that is, were the prospects of interim dividend. They didn't issue interim dividend. Probably we might see a full year dividend coming in. Results, of course, from many of the banks.
They have announced it.
Okay.
Yeah, and it's doubling.
Who you're talking about? Stanbic?
Yeah.
No, I'm talking about other banks.
Okay.
Yeah, so the results, of course, as usual, Lista is not paying attention. So, I mean, the results for the other banks is supposed to come out the next coming week, and of course the other one. Of course, we'll be waiting for the results of the only lion in the savannah, but today is Stanbic. How did Stanbic perform, guys?
Stanbic did pretty well. So their profit before tax rose by 57%.
Wow.
To 9.76 billion. Net profit was up 39% to 7.2 billion shillings. It's good. It's good amounts.
That's up from 5.19.
Yeah.
I think these results are very, very consistent with what we saw in the half-year results. So in the half-year results, we saw, of course, banks, the economy coming back, there's a boost in the economy. And, of course, banks, as I always say, is one of the areas that, it's indicative of the general economy. So the banks, coming from the dips in 2020 and performing better. So this is well in order. This is something that I really expected. And that 57%, I know in relation to other banks, we are perhaps poised to see triple digit, growths in PAT for other banks. In banks like KCB, Equity, we saw 98%, 101% increase.
What PAT, your profit before tax?
Yes, actually PAT.
Okay.
Yeah, so I mean, so now with the cutting of provisions and all that, so and the restructuring of loans that were done, now they were restructured back to the positions where they were. So I mean, it's a good outlook.
Just you're done?
Yeah.
Is that how it works? Once you've I do want to cut him.
That sounded like such an argument question.
You see, once you've restructured loans during COVID, so you're having loans, you have a loan book, then COVID kicks in, now guys can't pay you, so you restructure their loans.
Yeah. So for example,
do you have to restructure again?
So yeah,
when things are better, you just can't continue with the restructured.
You can restructure again. And here's how it works. Let's say, for example, it's in asset financing. Okay, so the year is 2019 December. You've gone in to buy a bus, let's say, and the bus plows the route of Nairobi to Mombasa, for example. So the bank has financed that for you. Come March, let's say May of 2020. In fact, you can't access Nairobi, because it's locked. So these people can't pay their principals, the installments that they're supposed to pay every month to service the loans. They can't pay it. So you have to double down to, let's say, if they were paying 50,000 a month, they now have to pay half of that, let's say 25,000 a month. Because their carrying capacity is not full. But then now that resumption of carrying capacity is back, the economy is booming, people are traveling, you can resume back to the 50,000 that they were paying initially every month.
But that's
the logic.
That's the decision for the borrower to make.
It's actually I don't want to say it's a mutual decision, but the bank actually carries the weight. So the bank actually writes to you and tells you now that the economy has bounced back, because they know your business. They know your business, that now you're carrying full capacity. So now you hire better than you were initially.
Yeah, because my understanding was that the loan books or the loans were restructured, right? Then now people, again, buses are now, using the example you've given, the buses are now carrying to full capacity. So loans are now performing better than they were before. So all that has changed is not that they've restructured restructured what they had structured during Corona, but it's just the ratio of non-performing loans that has gone down.
That's also possible because there were a number of restructuring options that were available.
Yeah.
I think one was I could call it a moratorium or deferral of your payment. The guys were given, I think, a full 12 months.
Sort of like amnesty.
Where you don't need to make any repayments. And then there are those who probably were also given a similar amnesty on the principal, but they just needed to service the interest portion of their loan. So for most of those guys, after 12 months, then it reverted to the old structure. But then there are those guys who renegotiated, either extended the term. So assuming you had 5 years left, they renegotiated to have it maybe 7 or 10 years, which in a sense reduced your monthly payment. Of which I think for most of those they did not have to restructure. They still go on with the new restructured plan. So that's what the kind of loan forgiveness, if I can call it, that we saw, the restructuring options that were there. When we go back to Stanbic and the results, so for them, their earnings, they say it was attributed to two main things. The first one is there was a drop in impairment charges, and then rising interest income. So the interest income rose from 12.8 billion in 2020 to 14.37 billion.
That's expected. So impairment charges, are they referring to non-funded income, non-interest income for this case?
That's what I was going to ask you guys.
They said a drop in
impairment charges.
I think because
there's a
non-performing loans are expensed mostly.
Yes,
right?
yes.
So that is what I think that is what they're referring to. Impairment charges are non-performing loans.
Okay. Dan is just looking that up, but I mean, I'm looking at also.
Yeah, you're looking it up, or I'm right.
No, I'm looking it up.
Okay.
So I'm looking at. For me, I'm doubting that probably it's non-funded income, and I'd be worried if non-funded income is going down.
No, that's not a good thing, because they attributed the growth or the success to the drop in this non-funded or the drop in these impairment charges.
Yeah. So
in
if
that case, impairment charges
charges
cannot be a positive thing. A drop in impairment charges cannot be a positive thing.
And that's what I was saying exactly. So I'm looking at that, and because Stanbic, the way it's structured, they're mostly in the corporate banking, not much of retail. So in the corporate banking, like, there's a lot you can do. You can be a transaction advisor, which we've seen Stanbic do, also with the work with MTN, the IPO and all that. So non-funded income, in this case, I should expect non-funded income to be really, really good coming from Stanbic. So Dan is looking that up. But there's something I just wanted to ask you guys. I wanted to know how did the loan book, Stanbic's loan book, perform? Because now, going back to the point of the economy coming back and Stanbic being mostly corporate banking, so you find that many businesses that had scaled down or even closed, now during 2021 being a recovery period for many businesses in Kenya, you find that if they'd scaled down, it's now time to rescale up, so to speak. So if you had fired a couple of people, it's time to rehire. It's time to get an extra machine, probably a larger room than the one you had scaled down to for your operations. So businesses needed credit in 2021, and they're still needing credit in 2022 a lot. So I'd suspect that the loan book was up by double digit. Is that the case?
Yeah, the loan book actually quite grew. Not too big, because it was in the loan book or loans and advances in 2020 was 196.3 billion, and then in 2021 it was up to 229.32 billion.
196, 229.
Not much.
Yeah, like 34 billion increase.
Mental math, eh?
Not as big as I thought or as I would have anticipated, but I think it's just part of the bank being cautious with COVID.
Because from what Keegan has explained, you'd expect that guys would be hungry or actively looking for
absolutely
for loans.
Because in the half year results we saw actually Equity was perhaps the only bank that loan book went up by double digit, around 21-22% if I'm not wrong. So you could see the need for credit at this time, and you can actually feel, for people who run businesses, they can feel the need for credit at the moment. But of course, as we've always said, there is a battle for the loan book between the government and the private sector, and of course the skills tilts in favor of the government because of different metrics. But back to Stanbic.
You asked about non-interest income or non-funded income.
Is it the same as
that was impairment charges? So basically,
no, that's different. Let me give you this before we go. So that non-interest income that rose from 10.44 billion to 10.62 billion.
10.4 to 10.6.
Yeah.
Again, that's marginal, not double digit what I wanted.
So double digits.
Okay, the loan book rose by 16%.
16%, double digit.
I think then the emphasis shifts from the quantity or the size of the loan book to the quality. Because COVID, because you're coming from COVID, now you don't have to look at how big is your loan book, it's how much can people afford to pay.
And it makes sense to look at the quality, because I mean, if we look at all the sectors of the economy, the sectors actually, you find that they recovered at different times and with different speeds. There are actually some sectors which actually COVID was the best time, you know, like e-commerce, where you find that now people are buying things online, ICT, from the report that we had, KNBS report, 2020 survey. So these are some of the sectors that really did very well. So I guess the quality in this case really matters. It's not just about how much you've dished out, but to whom and to which sectors.
So so that was
Mr. Dividend. You're happy?
Yeah, very, very, very happy. So their dividends, they gave quite a juicy dividend. So dividend rose by 38.84%.
What?
So they're giving a dividend of no, that's not dividend. That's earnings per share. Earnings per share.
Still.
Earnings per share rose 38.84. So to 18.23 shillings from 13.13. And then the dividend is now at 9 shillings per share.
Wow.
Up from 3.8 shillings in 2020.
That's more than 50%.
That's more than double, because 3.8 times 2. That's 6.4.
Oh, we're talking percentages. That's more than 100%.
More than 100% increase.
And I'm actually looking at the share price at the Nairobi Securities Exchange, and Stanbic on Friday 4th actually closed. Friday?
No.
Friday 4th. It closed at 99.75, and this was it actually went up by 4.2%. So I think the market reacted to that, because the dividend.
Is that the kind of response that you'd expect? Because I think 4% is too small for such a huge thing.
For one day, that's big.
This is just Friday. And the results came out, I think, on Thursday.
Okay.
So for one day, it's pretty good. And so this is
that's someone to. This is me.
Plus,
this
it was expected.
That's someone to buy.
It was expected.
Because next week is gonna be a run.
Of course, with the Lion coming out, Equity results coming out.
There's going to be a run on who?
I mean,
on this particular counter.
The reactions.
Why?
This particular counter?
Because after the results were released, the market, there wasn't enough time for the market to respond. That's what you're talking about.
On Friday.
You think it's gonna? No. I think 1 day, 1 full day is enough time for the market to react.
No, 4% is kidogo.
Because at the end of the day, you have to look at it this way.
And you're doubling
the market is known. The market, if the market knows that Stanbic they gave an interim when people actually weren't giving interim in the banking sector. So it was very much expected that they're going to give dividend. It's the same way as Stanchart. I mean, Stanchart are going to give dividends. Like, tell you what, Dan, that come next year, a time like this, BAT will give dividend. Like that, you're sure. Like, you're 100% sure. So, I mean, this was expected.
But do you know how much they're going to give?
I don't know, but I know it's going to be in the neighborhood of 80%.
This is the highest Stanbic has given.
Yeah.
Exactly. So that's 4% is too little reaction.
I think it's normal since it was expected.
Normal for something that has never happened? How do you know it's normal?
Okay, these are nitty-gritties.
Yeah, but so I don't know whether I'm trying to see whether that they mentioned something on it being a policy going forward, the amount of dividend that they're going to be paying going forward, because this one is 50% of their net profits that they're giving out.
Do you think, Dan, that since Stanbic Bank here in Kenya is a subsidiary of Standard Bank, which is the biggest bank in Africa by asset size, that when a company is a subsidiary in this matter, that it tends to have a really not dividend policy per se, but it tends to issue dividends more than likely.
Yeah.
Because
of the parent.
The parent company has to get money.
Yes.
So think of it this way: the base titanium down in Kwale County at the coast, you see the amount of dividends that they normally remit to the parent company in Australia. So the parent company at the end of the day has to see the money. So I'm just making a deduction that perhaps subsidiaries tend to issue.
They tend to that's what tends to happen. Even with I think most companies that have a good shareholding from abroad, even with BAT, that has significant shareholding.
Yeah, in the UK.
Yeah, you find that they tend to want to repatriate the profits to the shareholders. So the minority or the local shareholders end up benefiting as a result of that.
Absolutely.
Yeah. So Stanbic, I think that dividend 9 shilling per share is quite good. You said what was the price on Friday?
The price was 99.
99 bob. Yeah, 9 shillings, so that's slightly under almost 10%.
Yeah, 10%
dividend yield, which is
fairly okay.
Quite good.
Yeah, in this market where dividends is kuna uhaba wa dividends.
What's the dividend policy for BAT?
BAT 80.
80. This one is about 10.
This one they've given 50%. I don't know. I've not seen the dividend policy yet for Stanbic.